The UK's consumer price inflation data out earlier today on this Tuesday, CPI coming in lower than forecast in July on the back of another sizable fall in fuel prices. It registered 2.6% year on year, equal to June's figure, but lower than the 2.7% that was the consensus of economists' forecast. Now, the key to this, so far as the Bank of England is concerned, is it takes a little bit of pressure off the BOE when it comes to expectations that the bank might have to raise interest rates sooner than some are saying it is possible, given the current conditions, bearing in mind the big unknown, which of course is Brexit. Let's take a look at the chart. The trade today has seen a drop for sterling against the US dollar. And in fact, it's just come back to this point here, which is the point of support. We saw the low back on the 14th of March 2017 this year at 121.06 in this move up that we've seen for sterling, peaking out at 132.66 on the 3rd of August. Since then it's been this pullback. We went through some key support at 129.65 as of today's open, and we've just traded at the bottom of this upward support line, which maintains support at 128.64. Now, if we break down below that, you've then got support here at 127.93, and then another level of support which joins the 200-day moving average down at 126.67. Then another level of support at 125.60. So a number of support structures are in place if we see further declines for sterling. Just want to overlay a Fibonacci on this to give us a better explanation as to where we are. We've got the current retracement here at 61.8 from that swing low point there on the 21st of June to the high that I was talking about traded on the 3rd of August. So that's a 61.8% retracement, which is a key level of retracement. That is, if you think that all this is doing, this pullback, is a drop in what is otherwise an uptrend in the market. I'm not completely convinced that that's the case here, especially bearing in mind the rather fragile backdrop to the British economy. So certainly we could well see this upward support line here taken out. Let's take the Fibonacci off just so that we can take a look in some more detail about what's happening. So if we do take this support line here out with a daily close below that, you then got the support here at 127.93, and that for me there is the base case here. Now, what do you do if you do go short on sterling dollar? You want to put a stop on above where the previous level of support and resistance was, and that's the 130.48 level. So 138.50 would be a really good place. 130.50 would be a good place to put your stop, just above here if you go short on this. Now, if we see a continuation of support given by this upward trend line here, and we do see a reversal, in fact, sterling starts to recover again, that is, we get a weaker dollar as well. That's the other side of the equation. Then you want to be looking as this here as the baseline from which to work higher. And if you do go long as you pitch out from here, you're only putting a stop down around about this sort of level here, around about the 200-day moving average, just below that, which coincides the 126.60 level. So at the moment, at least, sterling is given support here. If it breaks below this upward support line here, you've got support coming in at 127.93. So very much a moment of inflection there for sterling. If you look at the MACD, you're looking here at a lower trade, a lower momentum, which would indicate that we are going to get a break of this line, which for me is the base case. But if we do get support there, we could see a higher print for sterling in the next few days.